Well, welcome back, John, to 2024's first episode of The View. I hope you're pleased to be back in the saddle. I certainly am.
Yeah.
John, what do you think are going to be the big investment themes of 2024?
Well, I think it's already started, Paul. I think the inflation cycle has broken, so we're on a downward trajectory on inflation. Now, the point is that the interest rates never went up, apart from America. Interest rates didn't go high enough or to match inflation. So now we've got inflation coming down. A lot of pressure on currencies ex-US will be released, so that pressure will come off, particularly the Australian dollar. The reading yesterday, Paul, inflation about 4.3% trail in Australia, cash rates 4.1. Doesn't take much imagination to see that in the next 3 to 6 months, inflation will be below the cash rate of Australia. So we'll have positive real interest rates. I was just looking at a chart earlier. If we get above 0.5% to 1% real interest rates, that's the first time in about a decade. So that's good for people who are looking for yield, cover inflation. So that's going to become a theme for markets. We've already said this, Paul, that people should be locking in these interest rates, which are appearing. I think that the bank term deposit rate will be bid down fairly quickly in the next 3 months. So not much relief there. But some of the corporate debt paper will come into play if it's not already. And there'll be strong support, I think, for the property market again. Good yielding property market. I saw this morning that the big industry funds think the down cycle on valuations for commercial property is probably past. I'd agree with that. There's probably a bit of a buying opportunity in recovery in the property trust market of the stock market. And then you've got high yielding stocks which have some growth momentum and which will be coming into play. So I think the equity market's reasonably good value. Looks like a good return coming out over the next 18 months. And it leads you all the way back to our big sectors, Paul. You know, the big sectors of the Australian economy and the market, the resources sector. Well, we saw a great trade account number this morning in excess of 11 billion. That tells you that our exporters are doing very well. So your BHPs and Rios and the iron ore companies are doing very well. On the flip side of that, the short-term pressure coming from the trade account was the consumer. Imports are down. Discretionary imports, but that will rectify itself in the next 6 or so months. So, you know, the themes will be market stabilising after a strong rally and then moving steadily higher again as 2025 comes into focus with quite a lot of growth momentum in the Australian economy.
Yeah. So, I mean, there's a lot to drill down in that answer. Let's just start off with some of that economic data that has come out in Australia just over the last couple of days. The first one was the CPI you mentioned came in at 4.3 over the last 12 months. So I think it was pretty finely balanced whether the next move in official cash rates is going to be up or down. Coming in below expectations, now the consensus is certainly that rates will plateau for a while and then fall down. Anything more that you can tell us about the components of the CPI or some of the detail, or doesn't it really matter?
Well, it does. I mean, the trend lines are down on energy. I mean, we're not going to get electricity prices coming down because delayed pricing mechanism, but we're seeing the cost of doing business, which rocketed up in the first 6 months of last calendar year, are playing out, apart from wages catch-ups. We're seeing a steadying in prices. We've had announcements this morning, I think, Paul, regarding coals. We probably will talk about the retail sector, non-discretionary, which I'm fairly bullish on, although the government's focus on that is a concern. But coals are dropping prices, and particularly prices on meats, lamb and meat, by over 20%. So that's got to be positive for inflation. So I think what we've got is a continuing downward pressure. This has been a cost inflation cycle. Despite all the nonsense coming out of the Reserve Bank and a lot of economists, this has been a cost-driven inflation cycle. We haven't seen it in a long time, so people couldn't understand it when it hit them in the eyes. And all those cost pressures are coming out more so overseas than Australia. Australia's delayed because of our stupidity in the way we manage the economy, but we'll be clearly out of this inflation cost cycle by the middle of this year, and inflation will come back towards, if not below, 3%. So there's no point in increasing interest rates if it's a cost cycle, not a demand cycle. And that trade account number this morning shows you that the demand side of the economy is quite weak. So why would you put up interest rates, which all that's going to do is put up the cost of doing business? Because every business has borrowings. So why put up the cost of doing business by putting up the cost of borrowing? So the Reserve Bank should sit on its hands, do nothing, let the inflation cycle work its way through, and probably I think, as you said in your question, hold interest rates for at least the next 6 months where they are, get a good margin of interest rates above inflation, and then start adjusting the interest rates more along traditional lines, historical lines, where you're managing interest rates above inflation, not below inflation.
So, John, you mentioned that demand was pretty slow, and that really drove that trade balance number. So it came in at 11 billion positive, when expectations were 7 billion. And the difference really was a decline in imports as opposed to, exports shooting up. Exports have been strong for a long time, but one of the key components was motor vehicles, so demand from consumers much lower. Are you seeing a kind of a weak Australian economy, or certainly growing at below trend for calendar 2024? Or do you think that there are enough positives there not to be concerned?
Look, the issue, I think we've got to watch this savings ratio. And there's another ratio I'm watching through the RBA stats. It's the drawdown or the increased personal finance lending. So looking at both those charts, there's been a crunch in the savings ratio. So the household sector, particularly the borrowed household sector, is drawing down its savings. And then it's part of the household sector is moving into personal finance. We haven't seen that for quite a while, since pre-COVID. So that suggests that the economy is running at a low rate, sustained by increasing personal finance debt. That's caused by higher interest rates, which has caught a part of the economy. Having said that, there is the tailwind of immigration growth and population growth, which is offsetting that to a great extent. And I think the offset will be more significant in the second half of this year. So we'll get more tailwind than headwind, so long as the central bank does not put up interest rates any further. I think the cycle will work its way through a low growth period, as you say, Paul, not a recession, a low growth period, fine, and then quite strong growth emerging in the second half of this year and in 2025 as immigrants settle and they start spending money, start working, start paying tax. It's all positive. And the other thing which we have to flag is that there will be a tax cut on July 1, stage 3. So any slowness in the economy in the first half will be offset by significant tax cuts in the second half. The only question is why the government persists in not changing the structure of those tax cuts. I've never seen a government so caught up in what a previous government set. I mean, it's quite bizarre in terms of tax policy.
Well, it seems to be a promise made must be a promise kept. But just coming back to housing, I find it quite a useful way of thinking about the housing market in Australia is that roughly a third of people own their homes outright, a third of people have mortgages, and a third of people rent. One of the strong inflationary figures is still that rental income. Do you have a sense of where you think residential property prices are going over this 12-month period?
Well, we've had some numbers this morning. I think Queensland, particularly Brisbane, prices have rocketed. Now, that was predicted. I think some of our Queensland clients recall that we predicted that, a year or so ago with the Olympic Games coming. So that's quite a normal cycle for property in the Olympic Games hosting city. Gets quite a big boost for a decade before. But there is obviously migration going north continuing, and Brisbane's becoming a much more livable city. The report this morning said that Brisbane property is almost expensive as Melbourne property, which is quite interesting. Look, I think there's a natural barrier to prices of residential property going up. That's affordability. And if the banks hold the line and don't, push out credit excessively, if they restrict credit, then that'll hold the property prices in check. Now, whether the banks can do that amongst themselves, or whether they have to be directed to do that by government or regulators, I don't know. But to me, that would be a sensible policy I know it's painful for people trying to get a deposit, but it's much, much better for sustainability of property prices if we have some credit controls and some requirement that people have a reasonable deposit and don't gear up excessively at what could be said to be inflated prices. In terms of the rental market, there's obviously constant demand there. The other thing you don't want to do is put up the cost of debt, because that cost of debt has to be recouped in rental. So again, the figures this morning said that there has been some plateauing in the rental market in terms of rental increases, and I think that's affordability, Paul. I mean, even recent immigrants aren't going to be highly paid. So, there's only so much people can afford to pay.
Yeah.
And the worst thing for a landlord is to have a vacant property because no one can afford to live in it, or he loses a tenant who loses his job. So I think we're at a period where we work through, but it'd be very interesting to see what the government does in terms of management of the property market and some rigour it puts around credit creation.
John, we've got just a few minutes left, and I do want to touch on some of the geopolitical issues that we're battling with at the moment. There are three that immediately come to mind. One is, according to polls and so on, there's an increasing chance that Donald Trump will get elected in the presidential race come November. And I wonder if you have any thoughts on what the market might be, the market reaction to that. Although it's still a long way away, we need time to think about that. The second one is China. The post-pandemic recovery has been very lackluster. It hasn't really affected our export markets so far, but if that recovery continues to be weaker than we've seen in the past, perhaps it will. And the third one is something that has emerged, seemingly out of nowhere, which is in the Middle East, and the Houthi rebels are lobbing drones and missiles at shipping in the Red Sea, and all of a sudden, this is where something like 12% of the world's seaborne exports travel through and being held hostage by, a relatively small group. How do you factor any of those things into your thinking about markets?
Look, I don't think Trump's an issue for the markets. He wasn't last time. I think the American president, whether it's Democrat or Republic, is not going to fix up America's debt problem. There are more domestic issues which will be addressed by whoever's the next president, and probably more so by Trump than a Democrat. But I still say we're too far to go. I mean, I don't think we're not going to land on this for another 6 months. There's been dropouts occurring as we speak, Paul. Yeah. In terms of the Republican race, it's a matter of whether the remaining ex-Trump Republicans can get their forces together and have a ticket, and that'll come into play soon. In terms of the Chinese situation, I still see the numbers as recovery is unfolding. It's not dynamic, but it is recovering. It's had a very sharp downturn in this property sector, property finance sector. But the good news is recovery is occurring, and it's much harder to get high growth on a large economy than it is to get high growth on a smaller economy. So I think, again, everything is context, but recovery in China is good for Australia. You're seeing it in the trade numbers. You're seeing it in the iron ore price. The third factor, the Red Sea issue. I mean, I just don't think these rebels have any hope against. If America focuses on dealing with it, there's no way they can win. There's been United Nations votes this morning. The usual people didn't vote or was abstained. But the fact is, if America and its allies want to open up the Red Sea channel, they will do so, and no one's going to stop. So I just think that's another interesting issue. My final, I know you didn't ask this, but I think it's interesting, and I'll talk about this in coming weeks, and I think it's worth focusing on. This morning on Bloomberg, the 2023 numbers came out for LNG production and export. And this is going to become a theme which goes right back to our opening question, Paul, about inflation. Now, America looks like it's become the biggest producer of LNG in the world, beating Australia and Qatar. And that's come out of nowhere. It's also now become a major oil producer, again coming out of nowhere. Not something which the American government or president has promoted, or not something which is coming up in domestic debates, presidential debates. But America has done what it had to do to fight back against the risk of inflation. And having done that, that's really stabilised the inflation cycle, not only in America, but the rest of the world. So oil and the cost of energy now will be under constant pressure because of this emergence. And that's going to become the big theme. Now, it's not geopolitical, Paul, but it's economic. And it goes to my point that I read all this stuff about all these issues, geopolitical, but I think they're swamped by the fact that despite what we see in America, it's getting its act together and is doing what it has to do to fight inflation, bring down inflation. China will do what it has to do, Paul, to recover growth, and Europe will meander on. But the good thing about Europe is it's going to get off the Russian gas supply lines. So that'll be a welcome development going forward. So despite all these geopolitical issues, when you look at the map of the world, you can put circles around these areas, and they're very, very small parts of the world. The bulk of the world continues to grow. The Asian region, which we're part of, will continue to improve its standard of living. And Australia is a great place to live and a great place to invest in.
Okay, well, we'll have to finish up there. I think in future weeks we will delve into a bit deeper about valuations on the Australian share market, perhaps sectors to focus on, sectors to avoid. As always, it's a dynamic and interesting marketplace. All right. Thank you so much, John. That was a great discussion, and I'll see you next week.
Thanks. See ya.